Imagine you are sitting in a boardroom. The CFO just asked you, should we fund this expansion with debt or equity? Everyone's looking at you. Your answer could make or break millions in shareholder value. Welcome to Bankers Bootcamp, where we decode the finance frameworks that separate the good analysts from great ones. I am Ashutosh Garg, and today we are tackling one of the most critical decisions in corporate finance: capital structure and optimal leverage. By the end of this video, you will have a practical framework that you can actually use in real deal situations, not textbook theory, real world application. And stick around because I am going to show you exactly how companies like Reliance Industries and Tata Steel navigate this minefield. Let's dive in. What really is capital structure? Think of capital structure as your company's financial DNA. It's the specific mix of debt and equity that funds all operations and growth. But here's what most people miss. It's not just about the numbers on a balance sheet. It's about strategic positioning, risk management, and value creation. When Mukesh Ambani restructured Reliance's capital after the Jio rollout, he wasn't just shuffling debt and equity. He was sending signals to the market, managing risk exposure, and optimizing for specific growth objectives. Let me break down the key components. Debt capital. This includes bank loans, bonds, commercial paper, and other borrowings. The game changer? Interest is tax deductible. That tax shield can be worth hundreds of crores. Equity capital. Common stock, preferred shares, and retained earnings. No obligation to pay it back, but you are diluting ownership and paying the cost of equity, which is typically higher than debt. Hybrid instruments. Convertible bonds, preference shares, warrants. These are sophisticated tools that give you flexibility. Here's the critical insight. There's no universal best capital structure. What works for TCS won't work out for a steel manufacturer. What works in a bull market might destroy you in a downturn. Modigliani Miller, the starting point. In 1958, Modigliani and Miller dropped a bomb on corporate finance. Their proposition? In a perfect world, with no taxes, bankruptcy cost, or information asymmetry, capital structure is irrelevant. Firm value doesn't change whether you use 10% debt or 90% debt. Sound crazy, right? Because it is. The real world isn't perfect. But here's why matters. It gives us a baseline. It tells us if capital structure affects value, it's because of market imperfections. And those imperfections are where we create alpha. The trade-off theory, where reality hits. This is where it gets practical. The trade-off theory says debt creates value through tax shield, but too much debt increases financial distress costs. Your optimal capital structure sits at the sweet spot where marginal tax benefits equal marginal distress costs. Let me show you with numbers. Say you are analyzing a company with 1000 crore EBIT, 30% tax rate, and they are considering 500 crore of debt at 8%. Now without debt, EBIT 1000 crore, tax 30%, that is 300 crore. Net income 700 crore rupees. With debt, EBIT 1000 crore, interest 8% on 500 crore, 40 crore, EBT 960 crore, tax 30%, that is 288 crore, net income 672 crore rupees. But here's the kicker, the tax saving is 12 crore rupees annually. Present value of that tax shield could be 120 to 150 crore rupees depending on your assumptions. That's real money. Pecking order theory. How companies actually behave. In theory, firms optimize. In practice, they follow a pecking order. First choice, internal financing, retained earnings. Second choice, debt. Last resort, equity. Why? Information asymmetry. Management knows more than market. Issuing equity signals overvaluation. Investors discount the stock price. It's a vicious cycle. Look at Infosys. For years, they funded growth almost entirely through internal cash generation. Only when they needed massive capital for acquisitions did they tap the external markets. Step 1. Industry benchmarking. You can't determine optimal leverage in a vacuum. Start with industry context. Capital-intensive industries like steel, cement, power, they can handle 50 to 70% debt ratios. Why? Tangible assets provide collateral, stable cash flows, service debt. Asset-light businesses like IT services, consulting, they typically run 10 to 30% debt ratios. Intangible assets, human capital risk, volatile project-based revenues. Take Tata Steel versus TCS. Tata Steel's debt to equity might hit 2 to 2.5 during expansion cycles. TCS rarely exceeds zero point 0.1. Both are optimal for their context. Step 2. Business risk assessment. Here's your checklist. Operating leverage. High fixed cost amplify EBIT volatility. Airlines, hotels, manufacturing plants. High operating leverage means lower financial leverage capacity. Cash flow stability. Predictable revenues means higher debt capacity. FMCG's companies like HUL can safely carry more debt than cyclical businesses. Asset tangibility. Physical assets support more debt. Real estate companies can lever up. Software companies can't. Growth stage. Mature, stable firms can handle more debt. High growth startups need equity flexibility. Step 3. Financial flexibility analysis. This is where good analysts separate from the great ones. Optimal leverage isn't just about maximizing today's value. It's about preserving strategic options. Ask yourself, can we access capital markets in a downturn? Do we have unutilized debt capacity for acquisitions? Can we service debt during a 2-year revenue decline? What's our financing risk profile? Remember the 2008 crisis? Companies with maxed out leverage and near-term maturities got crushed. Conservative capital structures like Bharti Airtel's provided strategic flexibility. Step 4. Cost of capital calculation. Now we get quantitative. Your optimal leverage minimizes WACC, weighted average cost of capital. Now what is WACC? WACC is equal to the weight of equity into cost of equity plus weight of debt into cost of debt into 1 minus tax rate plus weight of preferred shares into cost of preferred shares. Here's the practical approach. Create a spreadsheet with different debt to equity ratios from 0% to 80%. For each level, estimate cost of debt. Increases with leverage. Calculate cost of equity using KPIM capital asset pricing model, adjusting beta for leverage. Compute WACC, find the minimum. Pro tip, don't trust a single point estimate. Run sensitivity analysis on tax rates, risk-free rates, and equity risk premium. Step 5. Credit rating implications. Your target capital structure must consider credit rating impacts. Why? Because credit ratings directly affect borrowing costs. A downgrade from AA to A might increase borrowing costs by 50 to 100 basis points. On a 5,000 crore rupees debt, that's 25 to 50 crore annually forever. Use rating agencies' methodologies. S&P, Moody's, CRISIL, they all publish rating criteria. Model your leverage metrics against their thresholds. Now our very first case study, Bharti Airtel's deleveraging strategy. In 2020, Bharti Airtel was staring at a massive debt from spectrum auctions and competitive pressures. Debt to equity was approaching unsustainable levels. Credit rating agencies were circling. What did they do? Step 1. Write issues of 21,000 rupees crore, one of India's largest. Reduce debt to equity from 3.8 under 2. Step 2. Monetize Africa assets, raising billions for debt reduction. Step 3. Optimize maturity profile, pushing refinancing risk into the future. Result? Stabilized credit ratings, reduced interest costs, preserved strategic flexibility for 5G rollout. This wasn't just hitting a theoretical optimal ratio. It was about survival and positioning for growth. Now the second case study, Reliance is deleveraging post-Jio. After investing over 3.5 lakh crore rupees in Jio, Reliance's net debt packed at 1.6 lakh crore in 2020. Some analysts questioned the leverage. Mukesh Ambani's response? A masterclass in capital structure optimization. Phase 1. Raised 1.52 lakh crore through a combination of rights issue and strategic investments from Google, Facebook, and others into Jio platforms. Phase 2. RIL retail attracted 47,265 crore rupees from global investors. Phase 3. Achieved net debt zero status by early 2021. The brilliance. He didn't just deleverage, he brought in strategic partners, validated valuations, and created an ecosystem. The optimal leverage strategy served multiple objectives simultaneously. Practical red flags to watch. When you are analyzing capital structure, these are your warning signs. Interest coverage below 2x. Company is one bad quarter away from distress. For safety, target 4x or higher in cyclical industries. Debt maturities concentrated. If 40% of debt matures in the next 12 months, that's refinancing risk. Smooth maturity profiles are crucial. Negative free cash flow with high debt. This is a death spiral. Companies need FCF to service debt without additional borrowing. Covenant violations. Even technical violations can trigger cascading problems. Always review debt covenants in detail. Building your capital structure model. Here's your step-by-step framework for your next deal. Model structure. Historical capital structure analysis. 5-year trend. Peer comparison matrix. At least 5 to 10 comparables. Scenario analysis. Base, optimistic, pessimistic. Sensitivity tables for key assumptions. Credit matrix dashboard. Key metrics to track. Debt to equity ratio. Debt to EBITDA. Target below 3.5x for investment grade. Interest coverage ratio. Minimum 3x. EBITDA to interest. Minimum 4x. Debt service coverage ratio. Fixed charge coverage ratio. Your optimal capital structure isn't static, it shifts with business cycles. Deleverage in peaks, maintain stiff flexibility in troughs. Growth opportunities, reserve capacity for strategic moves. Market conditions, tap equity in bull market, debt in low rate environments. Competitive dynamics, watch peer leverage for industry norms. The recapitalization decision framework. When should a company recapitalize? Lever up when you significantly under-leveraged versus peers. Tax shields are being underutilized. Stock is undervalued. Debt buyback creates value. Stable cash flows can support higher debt service. Interest rates are attractive. Delever when? Approaching credit rating threshold. Business risk is increasing. Refinancing risk is elevated. Growth capital needs are anticipated. Market conditions for equity issuance are favorable. So here's your takeaway framework. Optimal leverage isn't just a number. It's a range that balances tax benefits against financial distress costs, maintains strategic flexibility, and adapts to your company's specific circumstances. Next time you are in that boardroom and the CFO asks you about funding strategy, you will have a systematic approach. Benchmark the industry, assess business risk, analyze financial flexibility, calculate cost of capital, consider credit rating impacts. Remember, in corporate finance, there are no perfect answers, but within this framework, you will have defensible value-creating recommendations. If you found this valuable, smash that like button, subscribe to Bankers Bootcamp for more practical finance frameworks, and drop a comment telling me what deal or company you would like me to analyze next. Until next time, keep building that finance expertise. I'll see you in the next one.